I'm going to invite now my colleagues, Barry and Morris, up to the stage, and they will give you the regulatory update from an IAASA perspective. So, thank you.
Good morning, everyone. My name is Barry Murphy, and I'm an audit inspector in IAASA's Audit Quality Unit. I'm here today to present IAASA's annual update on the work performed by the Audit Quality Unit, or AQU. So in today's session, I will give a general update on the work of the Audit Quality Unit over the past 12 months. I will look at the pie market in Ireland and see what movements have occurred during that period. I'll present the results of the audit inspections that were carried out in 2022. I will cover the areas that we are looking at as part of our 2023 inspections. And finally, I will speak a little bit about the upcoming sustainability reporting standards. After the AQU update, I will hand over to my colleague, Morris Barrett, from IAASA's Financial Reporting Supervisory Unit, who will be giving an update on some of the topical issues relating to financial reporting that FRISU have identified. He will talk about the 2023 IAASA observations document. And finally, Morris will be speaking about the ESMA Common Enforcement Priorities for 2023. 2022 was the 5th round of audit inspections carried out by AQU, and it was the 4th year that the firm-wide reports were published. There continues to be 7 pie audit firms operating within Ireland, so no change there from the prior year. Our inspection selection remains a risk-based approach. We also make a number of manual selections which can arise from our discussions with our financial reporting colleagues and also based on our own analysis of market data that's available to us. We also continue to focus on inspecting audit partners and other responsible individuals who haven't been previously inspected. So we are now nearly 18 months into our hybrid inspection approach, so where we have both an on-site and an off-site presence as part of the inspections, and the feedback from the firms and inspectors continues to be positive. We are still on site for 2 to 4 days during a 2-week inspection, but it will also depend on the complexity and the type of the inspection that we are carrying out. 2023 was the first year of the implementation of the ISQM1, or the new quality management standard for audit firms. So AQU's work on this standard during 2023 focused on the firm's overall quality management systems, the identification of quality objectives and risks, and the design and implementation of the firm's responses to these quality risks. In respect of our audit committee work, we have continued to engage with audit committees throughout the year through a number of interviews with audit committee chairs as part of our PI audit inspection process. This is an excellent way for us in IAASA to engage with audit committees whom we would not usually have direct contact with. The main emphasis on the interviews that we carry out with AC chairs is getting their feedback on the audit, learning about their interaction with the engagement team, and what they thought worked well, and if there were any constructive points they had for improvement going forward. So moving on now to an overview of the pie population in Ireland. So as can be seen from this slide, the number of pies in Ireland continues on its downward trajectory and has fallen from 626 in 2021 to 544 in 2022. We can see there was a significant reduction in list debt entities, but all sectors of the pie market have seen a drop. In 2022, 4 audit firms, so Deloitte, EY, KPMG, and PwC, audited approximately 75% of the pies in the Irish market, a percentage unchanged from the prior year. And these same 4 firms earned approximately 87% of pie audit fee income in comparison to 89% in 2021. So I'll now summarize the results of the 2022 AQU audit file inspections. So this graph shows the grades assigned to the 35 audits of pies that we reviewed during 2022 and provides the comparative grading assigned to pie audits from 2021 to 2019. The chart shows that 89% of audits inspected received a grading of 2 or above, indicating that the quality of these audits was generally of a good standard. For the 11% of audits that received a grading of 3, more substantive improvements were required. So now looking at 2023 and our current round of inspections, this slide sets out the areas that we're focusing on. So audit evidence areas are identified across risk areas, and there would typically be a crossover here between the significant risks and the CAMs or key audit matters identified by the engagement teams themselves, although we do sometimes include areas that weren't identified as significant risks by the audit team. We've been looking at management override of controls, and this work would also involve an assessment of the fraud assessment performed by the engagement team and the journal entry testing. We've been looking at communications with those charged with governance to assess the quality and timeliness of these communications. Related parties has been carried over as an inspection area from the previous year due to a number of issues we identified from the 2022 inspections. We've been looking at financial statement audit procedures performed by the auditors to ensure that they are obtaining sufficient evidence for all material disclosures within the financial statements. And finally, engagement quality control reviews have been brought in as a new focus area for 2023. So moving on now to sustainability and the ESRSs. So the European Commission adapted the European Sustainability Reporting Standards on 31st of July 2023. And these are basically IFRSs, but from a sustainability perspective. They detail what disclosures are needed to be provided in order for an entity to be in compliance with the Corporate Sustainability Reporting Directive. The directive tasked EFRAG, or the European Financial Reporting Advisory Group, with developing these standards in the first instance, and this was done in late 2022. Significant concerns were raised by a number of stakeholders, including regulators, about the extent of the reporting that was required. In light of the feedback, the European Commission made some significant changes to the standards adopted, designed to ease the burden on companies. They changed the timing of the phase-in. They gave every company a so-called get-out-of-free card for the first 3 years, where they can omit certain disclosures on the basis that they explain why they have done so. And they have also now made all data points subject to a materiality assessment. Despite these attempts to ease the burden, there continues to be concern, and many stakeholders believe that the changes have actually made these standards more complex for companies. The ESRSs are still working their way through the European legislative process, and the hope is that this will be finalised in the coming weeks. However, this is very late in the day for companies who will be required to comply with these standards from the 1st of January 2024. So from an Irish perspective now, there aren't a significant number of member state options in the directive, although the Irish government has announced their policy intentions relating to the ones that do exist. So the general policy intention is to provide a degree of flexibility and to give preparers of financial statements as much flexibility as possible. Some of the key ones include the permission to omit any commercially sensitive data, and to have a sustainability assurance service provider who is different to the company's auditor. The option which has been most contentious is this option around independent assurance service provision and the allowance of non-auditors to provide assurance over sustainability reporting. It is not an option that is being taken up in the short term due to the complexity and the challenges regarding the time frame, but it is something that will be considered in further detail in the coming years. So looking now at the regulatory regime in Ireland, IAASA's remit is expected to expand to give us responsibility for reviewing the reports of issuers. This is the same population that IAASA is already responsible for as part of the accounting enforcement regime. And essentially now IAASA will need to check for compliance with ESRSs as well as IFRSs. We will also obtain responsibility for checking the assurance of these reports for public interest entities, and we will oversee the licensing and regulation of sustainability assurance providers via our review of the accounting bodies. We will also have powers to take enforcement actions in these areas where required. So finally, to finish the AQU section of this morning's update, these are the thematic areas that IAASA have published or plan to publish in 2023. So in July, a materiality thematic was issued on the IAASA website, where it is still available. This month, we published a thematic on communications with those charged with governance and how engagement teams are communicating with audit committees and directors. A disclosure insight series will be published shortly based on a number of findings identified over the last 14 months in relation to financial statement disclosures and the audit work in this area. And an ISQM1 observations paper will be published later on during the year. So I'm now going to hand you over to my colleague Maurice Barrett, who is going to give a financial reporting update. Thank you.
Good morning, everyone, and thank you, Barry, for that update on what's happening on the audit inspection front. I'm Maurice Barrett, Senior Financial Reporting Manager with IAASA in our Accounting Enforcement Unit, and I'm delighted to be here today to talk to you on some financial reporting developments. Today, I want to share our perspectives on some topical financial reporting issues, to talk to you a little bit about our 2023 observations document, which was published to our website on the 3rd of October, and to share some insights on what you can expect to see in the ESMA, the European Securities Markets Authority, on the ESMA Common Enforcement Priorities document that will be published later on this month. I hope that this talk will give you some food for thought on matters that you, as Audit Committee members, might usefully raise with your auditors as you plan your 2023 audits and as you consider the output from those audits. For accounting enforcement examinations underway so far this year, we've raised certain common topics across a range of issuers. Up to the middle of the year, the most frequent topics we've raised are set out on this slide. And you can see there that there's the Transparency Directive, IAS 36, IFRS 7 and 9, IFRS 8, APMs, ESEF, and climate risks and ESG. There also are a number of other topics ranging from IAS 1, risks, uncertainties and judgments and estimates, IAS 1, going concern, IAS 8, errors, IAS 16, IAS 36, provisions, and IAS 38, goodwill impairment. Looking then a little bit more detail at the Transparency Directive regulations, this is by far the most common topic that we've raised with companies in our examinations so far this year, and it reflects pretty much where we question issuers on how they have reflected climate change matters in their management reports. Remember that management reports must provide a fair review of the development and performance of the business, together with a description of the principal risks and uncertainties that they face. We regularly challenge issuers on the extent to which they've provided commentary and analysis of climate change impacts on the financial statements. We're not convinced that there is sufficient connection between the management report and the financial statements, and we suspect that there may be some greenwashing going on here. So, as Audit Committee members, you might ask yourself and your auditors, do the annual report and financial statements adequately reflect climate impacts? IAS 36 and IFRS 7 and 9, our engagements with companies on these topics reflect the broader macroeconomic environment, such as interest rate increases, inflationary pressures, consumer sentiment, and the various wars that are happening. We've challenged issuers on their value in use calculations, their discount rates, and the impact of climate change on the recoverable amount of assets. In the case of financial institutions, we've looked at particularly changes in forward-looking information. And again, as Audit Committee members, you might ask yourself and your auditors whether or not the broader macroeconomic environment has been fully considered in preparing the financial statements including the assumptions used and the uncertainties faced. Turning then to IFRS 8 operating segments, we've identified many issuers which changed their reporting segments from one year to the next. We engage with issuers on the identification of operating segments and the disclosures surrounding reportable segments. We've requested companies to provide us with their reports provided to the Chief Operating Decision Maker to substantiate their segmental reporting. As Audit Committee members, you might ask yourself and your auditors, do our segment disclosures reflect how the business is managed, especially if there are changes in how the business operates? Alternative performance measures continues to be an area of focus for us. Matters that we've identified include the balance between financial statement-based performance measures and adjusted measures, the reconciliation of the APMs to the financial statements, and the definitions of APMs. Again, as Audit Committee members, you might ask yourself and ask your auditors, does our use of the APMs meet the what, why, and how test? Do they over-egg a particular perspective of the company's performance? We've challenged issuers on the tagging of the primary financial statements and, for 2023, the tagging of the notes. And Audit Committee members might ask themselves and their auditors, does the tagged version of the accounts meet the technical requirements for ESEF tagging? The remainder of the topics that I mentioned previously reflect the issuer-specific and broad nature of the areas that we examine. Moving on then to some IFRS amendments. Firstly, IFRS 17 and insurance contracts. And while we have seen the impact of this on the only insurer falling within our accounting enforcement remit, we have not seen the impact on non-insurers, even on financial institutions with some insurance activities. We have not seen any reference to IFRS 17 in any of the 2023 half-yearly reports that we've read. And all of this is a bit surprising to us because IFRS 17 is applicable to insurance contracts and not just insurance companies. So that's something that we will likely challenge in our 2024 examinations. There are some amendments to IAS 1 and IAS 8. IAS 1 now requires disclosure of the material accounting policies. Previously, it required disclosure of the significant accounting policies, and there's an amended definition of accounting estimates in IAS 8. We've seen references to this in 2023 half-yearly reports, but all say that there's no impact. Again, this is something that we will likely examine in 2023 year-end reports, and particularly on any impact arising from accounting estimates. There is an amendment to IAS 12, which has an IASB effective date of the 1st of January 2023, but it is not yet endorsed for use in the EU. So we just have to wait and see, and we'll watch domestic tax legislation changes in this area. But if the changes are substantially enacted before the year end, but the amendments are not endorsed, then there could be issues. In any event, Audit Committee members might talk to your auditor on the impact of these developments at both the planning stage and the completion stage of the upcoming reporting season. We published our observations document at the beginning of the month, and it's available on our website. And that document highlights the uncertainties that affect us all and sets out the areas that we expect to look at when we examine 2023 financial reports. Many of these expectations are driven by macroeconomic developments and by findings from our 2022 examinations. All companies, auditors and Audit Committee members, and not just those falling within IAASA's accounting enforcement remit, the points raised in the paper have a wider application than that. All companies, auditors and Audit Committee members are strongly encouraged to read the observations paper and to ask themselves the question, do the financial statements adequately address each of the points raised? Turning then to the ESMA priorities. This is a European version of our observations document, for want of a better description. And the public statement is expected as normal to be issued at the end of October 2023. And the areas of focus in it are likely to be climate-related matters, such as consistency between the financial statements and the non-financial information, the existence of impairment triggers arising from climate-related matters, and disclosures surrounding green financing. It will also include sections on macroeconomic developments, such as increase in interest rates and impact on financing and refinancing, and the fair value measurement and disclosures. It'll also have sections on alternative performance measures and compliance with the ESMA APM guidelines. It will have a section likely on the ESEF, and it will have some references to sustainability reporting. For those audit committee members of companies falling within IAASA's accounting enforcement remit, each of these European topics should be on your radar when meeting with your auditors. Ask your auditors and your executives, have we met the requirement for each ESMA priority in your 2023 financial reports? And we're getting close to the end of this session now, and this slide shows links to some useful documents on audit inspections and financial reporting, which you can access on our website, and the hyperlinks to them will work in the slide deck that will be distributed. And with that, I will finish, other than to ask if there are any questions from the floor, which Barry and myself will do our best to answer.
We have a couple of questions in on Slido, which I'll read out to you if that's okay.
Okay.
So the first one is probably for Barry, actually. Will IAASA be inspecting sustainability opinions in 2024?
So not in 2024. So the timeline for IAASA's inspection responsibilities is yet to be determined, but it won't be in 2024, excuse me, likely 2025, 2026, that kind of time frame.
Great, thank you. If anyone has any questions in the room, just let me know and I can give you the mic. Otherwise, I'll read the next one in Slido. The next one is, will IAASA be looking at all companies and audits that are in scope for CSRD? That's probably one for both of you to answer.
So I might start from an AQU perspective. It would be the PI population within our scope, so there's no change there to the existing population that's within our inspection mandate. But not all of the PI population will be in scope for CSRD straight away. And then Maurice, from a FRISU perspective? And
from an accounting enforcement perspective, it's pretty much the same answer. Not all entities within our within our financial reporting review remit will have to do CSRD reporting, but those that do, yes, if we select an issuer that has both a financial report and a sustainability report, we will examine the both of them, yes.
But just to confirm, Maurice, you won't have any new entities within scope?
Our issuer population will not change because of CSRD.
Okay. Next one then is, do the audit inspection team and financial reporting team inspect the same entities, i.e. collaborate on the same inspections?
So probably one for both of us, but I'll start. So we do sometimes, so there isn't a direct correlation between the population of PIs within the AQU remit and within the FRISU remit, but we do communicate with our financial reporting colleagues. There has been an inspection this year where we both looked at the same entity. In 2022, there were 2 inspections where we looked at the same entity. So we do try and cooperate where there are common risks, but it isn't always the case, and it's made slightly more difficult by the fact that our population of entities are different. I would just say on that point as well, sometimes the financial reporting risks are quite different to the auditing risks, and it is possible to have a scenario where there are audit issues identified by the audit inspection team, albeit no financial reporting misstatements. So how this could arise is if there's a very strong financial reporting unit or company, they could ensure that all the material disclosures are correct and there are no issues with the financial statements, albeit there could still be issues from an auditing perspective with how the auditors have evidenced their work on that. So I suppose that's a scenario where the financial statements are fine, but there are audit issues. But to answer the question, we do speak regularly with our financial reporting colleagues, and we have done in the past and will continue to do joint inspections of the same entity.
I have nothing to add to that. We do joint inspections on occasion, yes.
For a question? Do have a few more on Slido. So this one's probably for Morris. When will the 2024 areas of focus be released so they can be focused on for 2023 year ends?
We've already published our observations document, which went up on our website at the beginning of the month. And that's sort of the domestic guidance, for want of a better description. And the ESMA, which would be the European guidance, the ESMA Common Priorities document will be published the end of this month and will go up on our website as well.
Great, thank you, Morris. And another one, has IAASA looked at sustainability disclosures by listed companies already, and have you found any issues?
We have looked at them, but mainly from the impact of those disclosures on the financial reporting and for example, the recoverability of assets, the provisions that might be required. So we haven't looked directly at sustainability reporting per se, no. But we have looked at the impact that might have on amounts in the financial statements.
Okay, that's all the questions on Slido, unless anyone else for a final one.
Okay, thank you very much. And I'll now hand you back to Kevin for the next part of the show.